Thank you for joining us today. I'm Dean Martino with the Cooperative Credit Union Association. Today is our last webinar Wednesday of 2025, and we have Dave Adams, who's the Senior Vice President of Lender Client Experience, joining us today to talk about the auto industry. Dave, I'm going to turn the floor over to you. Welcome.
Well, thank you, Dean, and thank you to the Cooperative Credit Association for inviting myself. And I'm joined by Jeff Kane. He's with me as well, my colleague here at Origence. My name is Dave Adams. I've been with Origence for 25 years plus. I've seen a lot of growth in this industry, a lot of growth in our company, serving credit unions. And, it's not lost on us. We talk about in management meetings all the time, hey, we're not just serving our credit unions, but we're helping you serve your members, right? These are real people using technology, that we provide to credit unions to serve members, to buy cars, to get that credit card, to buy a suit for their job interview. There's real life impact to what we provide. I'm a credit union guy through and through. I've got my CCE from Q's. I'm a management school trained. I'm a big believer in this industry and what we do as credit union professionals. I think we are difference makers when it comes to working in this industry. I think credit unions are a lot more tech forward than maybe some of the industry gives us credit for. We actually are the good guys or good women in financial services. So I love when I do what I do because I go home every day and go, hey, you know what? I help the good guys in financial services, and that's what we do. Dean gave me my title, but the title I wear is dad. I'm proud father of two boys. They're a little older now. One out of the house. One's a sophomore in college playing soccer. But I live in Kansas City by way of California. I know probably some of the folks on this are longstanding, Patriots fans. I'm a long-suffering Raiders fan, so they go silver and black, but they're really lousy, and it's fun to watch your Patriots do well again. Here's today's agenda. So I'm going to talk a little bit about a market update. There's a thing called tariffs. I know we're just worn out from that word from all aspects of life right now, but I want to talk about how it impacts your members when it comes to buying a car and what's happened to your dealer partners that are out there. There's some evolving, work with our dealer groups. This is one of the areas that keeps me a little up at night, not to be honest with you. Auto shopping and embedded finance, how your members are accessing finance is changing. As we know that Amazonification, if you will, of just how people want that instant gratification of their purchase. That's actually now getting into the car business, right? And then a little bit, if we have some time, I'll talk about some EVs. I do want to thank you on these next two slides because there's credit unions on here that are customers of ours, and we want to thank you. As an aggregate, we're actually 55 billion loans. Last year, we're going to probably exceed 55 billion this year. Probably going to come more like 58. When I'm looking at the numbers here about a week ago, 200 million members served. That's again that number. That's tangible. That means something to you. And if you look at the aggregate of credit unions, this high tide lift all boats, this cooperative, movement that we have in credit union, in the credit union world, it really makes a difference. Look at that brand power you have. It's not cuddle. This is not an us slide. This is, hey, thank you, credit union slide. If you come together, you're a force to be reckoned with when you compare against some of the biggest auto financiers in the country or even in the world. So if you look at that, Cuddle Credit Union's now 11.74% growth, by far got the number one spot. But I want to point something else on this slide. You've got Wells Fargo. Look at that growth. They're coming back. They've we're putting their money into some other asset classes at the bank. They're starting to come back. They are a force to be reckoned with in most markets. So just keep an eye on them. That I think they're going to give credit unions kind of a run for their money coming up into this year, into 2026. Again, just number of credit unions help 4 million by current. This is all credit unions. So I mean, gosh, if you look at the number of auto originations over the last 5 years, really consistent. Hopefully, we can gain more market share collectively. I think if we work as a hunt as a pack, if you will, I think we can actually dig into the bank market share. But again, 30% market share when it comes to auto originations going to credit unions. Obviously, we can't finance them if they don't sell them, right? So the SAR, which is kind of it's the barometer of the health of the auto industry, and that's the seasonal adjusted annual rate, right? Normally, it's a good spot to be is about 17 million new cars because those become used cars, and that's usually kind of healthy. We're a little under that. We're coming back after some lower years, but we're going to probably finish this year just above 16.1. That is down from the original forecast because there is a little bit of a tariff impact. Tariffs didn't impact this as much as you might think, and I'll talk about that in that section. But down, but then in the used car, there's definitely some better growth in the used car. We're starting to see some leases starting to come off and become used cars. Again, this is where usually the Credian's bread and butter is in the used car market. But at 39.4 into the year, we have a lot of big credit unions, some of the biggest auto lender in the credit space that are partners with us. But and so at our strategic council, we have a bunch of chief lending officers that advise us on what we should be doing. But we asked them and did a poll, and they're and kind of an average. Everybody's looking at about a 7.2% growth for 2026. Is some of I don't know how that fares to your credit union, but that's usually that's kind of what we're seeing as a blend. So that's good. We're starting to see a little bit of growth. We did a little more this year than last year. The year before, 2022 was our high water mark. We couldn't help credit unions move loans fast enough. Again, just another way to look at where this is at. If you look at historically, again, about 17 million is kind of where the sweet spot is. If it's really humming, we're going to probably end about 16 point again, and then next year 15.9. I've seen variety of these, but it could be anywhere between 15.9. I've seen 16.1 again, but we're calling 15.9 just looking at what this analyst used right here. That's what we're budgeting off of. Hopefully, man, I'm probably a day or two away from getting Q3 data, but I had to go to Q2. But good thing on the new car, credit unions are kind of holding their own. Again, the high watermark in 2022 as far as market share on the new automobile side. But you can see how you compare against some of the banks and captive finance companies. You are seeing the banks starting to go up. You're seeing credit unions starting to go up. You're seeing some of the captive finance actually come down in 2025. A little less subvention out there. So it's definitely looking a little more advantageous for banks and credit unions, especially credit unions, to go out and compete in the new car space. This is where we shine, usually in the used car, right? Most credit portfolios, when I look at them, they're usually about 2/3 used to 1/3 new. Credit unions are sitting at 27.63 here in 2025, kind of so they go back and forth with the banks. We kind of own the banks in 23, 24. They've kind of taken us back over right there, but we're neck and neck, and that's good. That's where the credit and bread and butter is. And I'll come back talk. This is actually kind of important that we stay competitive in this space, because I'm going to talk a little bit about affordability, and it's kind of forcing membership to actually shop in the used car space. At Origence, we sit on a lot of data. We have we said we have 56. We're going to probably have just under 60 million billion, excuse me, B with the B, and fundings go through our pipes. We have a lot of data. So I'm going to next few slides are actually data that we sit on, and I'd like to present it to you. This is actually new car. The blue line's last year, and this is the magenta line. It's one of our corporate colors. Is the this year in 2025, but it's kind of following the seasonality, if you will. If you look at, kind of goes up and down the seasonality. You saw a big spike here in April. And that was when the tariff kind of buzz really took wind, and we saw a lot of pull through demand, right? A lot of people are like, I'm gonna go buy a car now before the prices go up. So we saw a big spike here in the year, but then it kind of settled back into where it kind of normally does, the ebbs and flows of the seasonality. And we did see a dip here, and you'll see especially on the used car side. I mean, we saw a dip in November. That was the government shutdown, and we saw it did affect how credit unions serve members, and we saw a little bit of a slowdown there, but we're seeing a nice rebound here in December. So far, I just don't have those numbers to present just yet. But on new car side, looking healthy again, year over year analysis. Again, we actually did see, even on the used car side, saw a spike, and people went out and said, hey, I'm going to buy a new car. Wow, those things are expensive. Maybe I'll get a 2 or 3 year old used car with low miles. So we saw just a spike in our volume again with credit unions. I'm sure you saw the same thing back in April going into May. But again, it kind of fell into the seasonality of year over year, but we are seeing a nice strong over year performance with credit unions. Again, there's that little dip. There's that little dip in November, and that's to be expected. That was that government shutdown. Hopefully we'll be back. We're kind of trending better for December, even on the used car side. So great news for credit unions. You're finding out that you're able to lend, serve members. We're starting to see liquidity positions change, and that's a good thing. So I think we expect to even be a little bit higher next year. We think we'll be we're about 10%, 11% year over year, new and used. We'll won't quite be that high, we think, over this year, but we expect to be anywhere from, again, that 5 to 7%. and that's those for credit unions. It's a staple of your portfolio. I just want to compare in the CCWA footprint here. I actually put the uh, some comparative analysis here against what we see nationally. And you can look at your particular states. Now, just so you know, this is just new and used auto. There might be a little bit of RV in there, but I think I stripped it all out. These are actually where the dealer is located. So you might say, hey, I do business in Massachusetts and Rhode Island. Okay, that's fine. But we're looking at where the dealer is actually located for this analysis and where these loans are at. But you see, just again, look at your state versus the seven, against the benchmark of what we're seeing across the country. But this is our first key point. Here's our logo again. So one of the things I want to look at is system approval ratio. And why is that important? Well, if you look at just consumers and your member behavior, they would like they want a system approval. They want automation, right? And they want simplicity. They don't have to wait for an underwriter to get back to it several hours to buy your loan. So in today's day and age, with the sophisticated business models that are out there in decision engines, and now you overlay things like Zest AI or Synaptic or Experience Power Curve, you've got alternative AI data you can put on top of your decision engines. There's room for improvement for credit unions. We're seeing this is even too low nationally. But look at your friends in Rhode Island. That's where you try to want to strive to be, right? And this includes not only approvals, that includes counteroffers, just offers of credit. But if you look at your friends in Rhode Island, this is where everybody should strive to be. If you can get there, that's going to be important when you're serving members. You're going to pull through higher quality paper because your higher end consumers are expecting that approval, and you're going to have better dealer relations, and you're going to have just better pull through. If you can just change that one thing alone, you'll see an overall increase in the performance of your auto program. Again, our first key point, system approval. But great thing, I noticed Delaware a little higher on the terms. I think we probably have a couple bigger ones doing 84 month there, maybe skewing that up a little bit. But again, nothing over alarming that's completely out of balance. That's the only thing that kind of jumped out at me. A little higher loan amounts too in Delaware. Maybe they got a little bit of new car program doing well there, getting a little higher loan balances. But those are the only two things that jumped out at me is against looking at, again, the benchmark of what we're seeing across the country. A couple of just general things. I'm sure you already know some of this, but just looking at inflation, it is, it's holding its own, and we expect it to be right in here. That's great that the Fed's actually dropped rates down a little bit, that we've been watching this to see what the Fed would do. There's a lot of news on that, and I'm not going to pretend to be the economist expert on this. In fact, I introduce our economist on our webinar tomorrow that will be talking a little more of this and more in detail. But we've been watching this like a hawk, again, get that rate environment in check, help liquidity positions of credit unions. But here's the forecast we see is about 2.2 to 2.3. Just looking at what we're looking at as far as inflation. Loan to share, you can, it's actually improving, although it's coming up just a little bit, but we're more not, as I talked to credit unions across the country. Liquidity position is helping. Again, that helps just your ability to go out and lend. Auto lending is usually one of the first places to come back, and we're definitely grateful for that. But obviously, this is again, this is important for credit unions. Again, we're not just putting balance sheet fillers here with car loans. You're helping your community. You're helping your members actually with mobility, right? This is important. People got to get to work, got to take their kids to school, got to take their kids to soccer practice. That's how we want to look at that. More of the same, just looking at a lot of credit unions have really managed their deposit now. They're seeing deposit growth next year. This is coming from Callahan. I'm sure you said in the same webinar that we do, but in case you haven't seen it, just want to show you, we're looking at next year in 2026, some good deposit growth again at 6.2 and some loan growth again, forecasted about 4%, about the same it was this year. So again, I think that's going to help. We're starting to see, we're starting to have more and more conversations of credit unions looking to expand not only auto lending, but general lending through our rails. We look at the tier treasuries kind of when we're looking at forecasting, and and maybe this is what you look at as well, but just looking at the spreads. I mean, they're actually you're starting to see a spread again between your auto rate and then your 2-year treasury. Starting to look at that. We actually look at that comparison. If we start seeing that treasury comes up, some credit unions will, hey, maybe I'll invest a little bit versus lend, and it helps us kind of know how we can serve credit unions what their lending appetite is. So this is next handful of slides are I guess another key point, right? Here's our logo, and this is outstanding. And actually, I just saw some data that this is actually crested $50,000 now as far as a new auto loan. That's insane. An average new auto loan is over $50,000. That is a really big loan. If you look at the change, it's the percentage change. It's obviously come up, it's coming back up again in 2025. We saw a big spike during COVID. Remember, there was no demand. There was a high demand, no inventory. So it was that whole thing flipped around. That was an anomaly. But we're starting to see a big increase starting to see that accelerate as far as pricing coming back at the rate of 2.6. But again, $50,000 for a vehicle. You're starting to see that payment now come up. Again, just look at the amount financed is up. The average loan rate is down, which is good. If you look at the new monthly payment, it's now almost at 750. And I'll have another slide on this in a second here, but an average rate of 750. I think my first apartment rent payment before I was in college was less than that. So I mean, you're looking at it's a pretty big deal, and then average terms got up just a little bit, right? I kind of to be expected if this goes up. One of the triggers lenders can pull, banks, credit unions, or otherwise, is extend that term, right? So you're starting to see a little bit of increase in the term on a new car. On a used car, it's actually holding its own. Again, this is that coming off those big years in COVID. You see the price of a used car inventory was scarce. You're starting to see it kind of normalize where it normally is. Again, rates going down. Payment here is not as much of a factor. It's a little more affordable for the average consumer. Again, expect the terms to be kind of holding steady. So this is incredible. So almost 18% of new cars here in the payments over $1,000 now. So the highest tranche, if you will, payment tranches is now over $1,000. It's pretty outstanding. And if you probably be thinking, if I had to ask you, I know we're not muted, we can talk in the discussion part, but if you had to guess, if I asked you, hey, what's the vehicle that's the most common vehicle that's over $1,000? It's actually the Ford F-150, believe it or not. So it's one of the most common cars purchased in the United States. $1,000 payment for your presenter here drives an F-150. I know what that payment's like, so I can speak firsthand about that. I'm a truck guy. I love doing stuff in the outdoors, so it's kind of my vehicle of choice. But I don't drive a lot. Luckily, I work from home or I'm on an airplane somewhere. But still, that payment's pretty outstanding. $1,000. If you look at the used car, it's actually kind of the inverse. Most are under 400, right? So and that's including all used cars. So you have a lot of older, higher mileage vehicles that are in there as well. So you kind of to be expected, but obviously gets the affordability of a used car. If you look at payments that are over $800, it's a smaller pool, but most of those are actually under $400. But that's including all used cars. The reason is, the negative equity, smaller down payments. So you're starting to see some of that, back coming in before the pre-pandemic. You're starting to see customers, with negative equity came down when people were flush with cash with the government stimulus, but now you're starting to see that negative equity fly up. And we got to get this a little dated information. I don't have 2025 on here, but hopefully JD Power will get that slide here in Q1 and see how we're looking in 2025. Used cars. This is interesting. We're looking at franchise versus independent. Again, so franchise dealers typically they focus on new cars in their service centers, but used cars is a big piece of their business, and they realize that they're experiencing that affordability challenge just like we are as lenders. They are as retailers, right? But if you look at this is franchise and independent, and look at the credit union market share. Obviously, credit unions really kind of focus on franchise. I know you probably have some really good independent dealers you could be working with, but in general, that we're at just about 31% of market share when it comes to franchise dealers looking at used cars. The banks are at almost at 39%. I think this is a big opportunity, especially with the affordability challenge. I think credit unions can really inverse this and really compete and actually improve their position here when it comes to market share as an industry. I think there's a big opportunity. There's no reason the banks should be eating our lunch here. Again, just another key point. I think I've only got one more left, I guess, but or one or two more. But here's a key point. This talking about again, just there's an opportunity to get into, just as customers are pushed into kind of older vehicles or late models type. So you look at just where they're at as far as new and used, as far as this is back at 5 years ago. This is now 2020 versus 2025, but by age groups. So if you look at now this little pink, it's looking at, hey, they're starting to see an increase in older vehicles, but you're also starting to see an increase a little bit in that newer, and you're starting to also see a decrease in that 3-year model years. I think there's going to be some tighter competition for here as members try to buy cars probably in this range. So something to watch out for, and maybe an opportunity to really help again, your members and also your dealer partners. New vehicle prices. It's interesting. You look at this. This is kind of what I was trying to. There's another way to look at what I was talking about. If you look, these are the top 50 models, so not all cars, right? This is just the top 50 models of used car pricing. And if you look at the average, this is the 2024 3-year average, right? And so you see the price of the vehicles here. You notice you come in towards this is in the springtime, coming in the summer here. You saw an increase here in 2025 is that 3-year-old vehicle, that top 50 models, just that kind of new used car, right? You saw an increase in pricing 4%. Again, there's a bigger competition for here. I think consumers are looking for that. I think dealers are aware of that. But then that's driving those prices up a little bit. That also could help when you actually dispose of a vehicle through remarketing, but just something to watch as far as increase of these new cars as some of the consumers are looking from instead of new, again, looking at that newer. Hey, maybe I don't need a 2026. Hey, a 2024 with 20,000 miles, maybe not so bad. I can actually afford that. So just something to watch as we compete for that in that space. Overall, this is all used cars now. This is all models looking at 3-year-old retail, right? So this is not just the top 50 models, but all used prices, right? You're starting to see this. I know a big spaghetti chart. It's kind of an eye chart here. You're looking at basically 2019 versus back, last year versus this year. But, we're looking at this blue line here. You're starting to see the wholesale prices, kind of fall in line with retail. They got a little wonky here because of, again, I think that people were trying to buy new cars, getting ahead of the tariffs. You're starting to, in general, they're coming down, which is good for affordability, maybe not so great for severity of loss when you have to repo a car and get rid of it, that type of thing. But you're starting to see these lines kind of more come together. Again, talking more about affordability in the used car, just looking at just franchise versus independent. Again, we talked about this. It's another way of looking at it. Again, I think there's still great opportunity for credit unions to compete with banks in this space. I think and have a really good sound loan, just an opportunity for, again, and also serve members with that affordability. Good thing is what's driving some of this is the supply of this is the new car supply in 2025 is this little blue line here. It's starting to, again, it's doing okay. It's kind of following on the same trend line as most of last year. Before, where the previous years, the supply was a little tight. It was kind of driving prices up with that. And then here on the used car supply, you're actually this blue line. You're actually starting to see it's starting to improve. We're starting to see a little bit of improvement. Again, that will drive some of that pricing down on a used car. I'm getting run to the market stuff, then we'll get into some of the more fun stuff here. Stabilizing, as far as the incentive of transaction price, this is good. We're starting to see a little bit starting to tail off, and this is good when the manufacturers aren't pumping incentives through to push cars. Kind of makes the market a little more stable, if you will. So that's a good thing. So if you notice, it's really at a high watermark here at the beginning of the decade at over 10%. Came down because obviously dealers, it was a seller's market. They controlled the transaction, and consumers were paying more for cars than we did in the past. Then it started coming back, and now we're starting to see it come down just a little bit, which is good. So we don't want to see too much incentive out there. Just kind of it makes the market kind of jump around. Coming down at the last couple of slides of the market update, looking at lease maturity. This is September is when we pulled this, but we're kind of the expectation of this year. This is actually talking about ICE, and I just to kind of level set ICE. Some people are like, hey, what's an ICE? It's not the obviously what you see on the news in your big cities. This is internal combustion engine, your typical car, right? You're burning gas. So looking at hybrid, plug-in hybrids, EVs. I'll talk a little bit more about EV there, but you're starting to see some of these, the EVs, you're starting to see kind of predicted of whether there could be a lot of these coming off lease and actually becoming retail units on the used car side. We'll lot to watch here of how we're going to participate in that as a credit industry, what the valuations of those cars, the residual values of those types of things. We're going to be watching this like a hawk. I think there's an opportunity here. We just don't know what it looks like yet. to really work with these used EVs coming here. But generally, it's good that we're starting to see a lot more vehicles in general. If you look at the general trend line, that's good. Actually, put more used cars out there for consumer choice. And refinance, another key point. Got my key fob up there again. If you're looking at just an opportunity for refinance, it is expected to grow next year. We're seeing some growth again in 2025. That rate environment will sure help that refinance. I just want to caution is if you're looking at this as a strategy at your credit union, there's refi players that are better than others. I'll just leave it at that. And really want to make sure you're choosing the right partner to do business with. If you're ever concerned about choosing the right partner, myself, Jeff, who's on the call with me, glad to give you some advice there. We have some partners that know that are preferred partners that actually do really well here and actually process titles well. They have a good study, they perform well. And again, some are better than others, but there's an opportunity here for credit unions really to take a look at this if you haven't already. There again, another look at the market share. Credit unions own this space, and we should. We have the way we're structured, being really strong used car lenders, the way we serve members. This is actually in the way we can market to our members. This actually doesn't surprise me, but we own this, and that's a badge of honor. We own credit unions own the refinance space. Tariffs, part of this word. That's it. But if you look at, we have a couple different sources to look at. We went to NADA, and this information comes from later in the summer, but it's still relevant. I don't think it's changed all that much. But tariffs in general, if you look at the average price of a new vehicle, added 5% or about $2,100. Did it impact some consumer choice? Sure. But again, it wasn't maybe what we saw in the original headlines of the news. It did, cause a small adjustment in the SAR. Remember, we talked about the SAR, kind of that number of new cars being sold in the United States, down about 7%. Maybe, not, I don't know if it's even impacted that much, but that's actually what we know, right? This changes all the time, and you can get a little seasick watching the tariffs go up and down on different consumer goods, auto industry not excluded. But this could change on a dime, right? But this is what we know today. If you look, it's interesting. The reason why they haven't is the manufacturers have done a really good job about kind of absorbing that cost. And if you look at the MSRP change just this year, it's gone up a little bit. This is from August. I don't have anything more current, but it did, it's gone up a little bit as the tariffs were imposed, right? This is kind of when they were announced, and then you saw it imposed. So again, a modest increase, not catastrophic like people might have first thought, but it is, there is an increase. But the manufacturers did a really good job for your members and for the consumers to really try to absorb that cost as much as they can, like other industries have. But they've done things like now they're looking at, hey, maybe because I have to import this vehicle or these parts from Canada or Mexico, maybe I just won't offer this lower end model anymore. Or maybe I'll take some of the trim levels off this vehicle, or I'll just discontinue this line altogether. So it's called shrinkflation. So they're decontenting, if you will, their vehicles, and to try to keep them more affordable, try to keep them and again absorb that cost. And they're looking at supply chains and trying to all those other things that go behind a manufacturer to try to keep those costs down when it comes to tariffs. Another way you can look at it, this one's from Cox. The average increase on an imported vehicle about $5,500. So these are the average cost on one imported from Canada and Mexico. It's a little less, about 49. And then for vehicles that are assembled here, all U.S. vehicles, about $1,000 difference in price. So just depending on the kind of car you like to drive, you probably see a bigger increase, whether it's come from overseas or from Canada or Mexico or right here in the U.S. So again, I wouldn't say it's a nothing burger, but there's the impact. It's there, but it's not as much as we all first thought when we probably started reading the headlines back earlier this year. This is going to be another key point coming up. And I want to talk about dealer groups and why this is important and why you should watch it. We're watching it like a hawk. We actually are trying to manage it here at Origence with our Cuddle team. These are some of these may or may not work in your particular markets, right? Where you do business with your dealer partners. Doesn't mean they won't tomorrow. That's why you need to watch this. So these are some of the most biggest auto consolidators, right? They own hundreds of dealerships. Some of them are publicly traded. But their MO is they're looking at how to grow, and they grow through acquisition, right? They like to buy other groups, buy mom and pop stores, add to their brand. And their key point is, if you're looking at, they're trying to consolidate by car, they might be buying a store that you've got a great relationship. Maybe you've got a $1 million a month relationship at a Ford store that's uh, near one of your branches or near your headquarters. But if they buy, what's that relationship going to look like? When these big national groups actually buy a store, but it's because here's why this is a challenge. They're very well run organizations, these big corporate stores, and they um, they have their processes, right? And sometimes they can control a lot of times with the lenders that the retail unit are trying to work with. They tend to want less lenders than instead of more lenders, right? So we've some of these groups have said, hey, I only want to work with 5 or 6 lenders across my entire dealer network. Well, what if I'm not one of those? What if your credit's not one of those 5? Well, what happens then? And how do so the one thing you can say that the other thing is they like to have preferred programs. They would like not only to get your financing, but they're asking lenders, say, okay, if you want to participate with us, yeah, I need a little extra juice. I need a little extra going to the corporate, with a maybe $50 a deal or $100 a deal if you want to if you want to be a preferred lender. So that's challenging for credit unions. How do we continue to, as an industry, compete here? I think our guerrilla tactics still work. I think just your local relationships at the store level, I think tend to work still. Now that could change, but I think you just continue to work those relationships even harder with that local relationship. The other thing is, this is kind of we have 2 people here at Origence that actually go out and try to work these relationships, and that's their full-time jobs. They go out to the biggest groups, try to represent or the industry of credit unions as one preferred lender, right? So why would you give up this buying power just because you want to consolidate with a couple of banks? So there's a couple of different ways. We're trying to manage from the top. Hopefully, credit unions are managing as with your relationship at the individual store level. We're starting to see 2 other trends with these dealer groups that we're keeping an eye on. So embedded finance. And I'm going to talk about that in another section. But some of these are getting into the retail game, right? So they're setting up their own websites about how to attract their members when they're looking for their auto search. Hey, they're coming into like Garf's site or the Group One, and they're actually then offering finance right there before the member actually gets to the dealership. And I'll talk more of that in another section. So that's something that's interesting is they're getting into that online retail space. Now they're actually offering finance at that point, right? Again, the member hasn't even stepped foot at one of their dealerships yet. And the other one we're really watching closely is some of these bigger ones like Lithia, AutoNation. There's one more that just talked, I think it was Garf, that actually they have actually created their own finance companies. So if they own their own finance company, guess who they're going to try to drive business to, right? It's going to be to their own. So we're starting to see increases in their own store share go to their own captive finances versus maybe going to a credit union or a bank or one of the other captive finances. Again, nothing to be overly alarmed about, but this is the one that like, okay, we're gonna need to watch this. These groups sell a lot of cars in the country, and just something to watch. Nothing to be overly alarmed about yet. Just watch this trend. Continue to compete at the local level. I think we're going to continue to compete, try to drive at the top level. I think we've had some success doing that recently this year. We're going to try to do this together with you to keep ourselves relevant with these larger dealer groups. Embedded finance, it's interesting. If you look at just the market share of these different cohorts, right? I'm a Gen X, so proud Gen Xer. But if you look at just, these are the folks that are starting to buy the cars now, right? Well, Gen X, millennials, they grew up with with a phone in their hand, right? An iPad. My kids never learned how to use a computer; they just did it. It's like it was always part of them, right? So again, the propensity of these 2 folks to actually buy a car, online without ever going to a dealership is starting to it's increasing. It's becoming it's like a normal. To me, that's a really big. We just talked about the affordability on that, both new and used cars. It's crazy that you would actually buy a vehicle completely online, but it's happening, and the comfort level of that is starting to become more tolerable for Gen X and millennials, even some Gen Xers. So it's changing, and so that changes where that point is of where the member obtains financing, right? So it's not necessarily going to be in the finance office anymore or at the retail store. They may be trying to get financing and buying products right there online before they even get to a retail point. Now, that's not to say that car dealers aren't going anywhere. They're alive and well, and they're they're very very savvy at what they do. I think there's going to be a little bit of a hybrid that some people do shopping here, but they'll probably fulfill their transaction at the dealership. That's kind of where it's going to become service points. But the shopping itself and maybe some of the where they arrange financing, some of the transaction discussion is going to happen online before they even get to a store. Funny if you look at EV buyers versus, remember there's the word ICE again. EV buyers typically, because of the way Tesla's made it so easy to transact with, they have a higher propensity to actually do a transaction completely digital. I don't know if anybody here has bought a Tesla. I have not, but I've got a lot of coworkers who have. It's pretty easy. It's pretty seamless to do it. The car actually just shows up at their house. They arrange financing right online. They can do it in a matter of just 20 minutes. I mean, it's pretty outstanding how they perfected that. So you're starting to see EV buyers are typically those manufacturers are straight to consumers versus going through a retail outlet. So they've got a little bit of edge, but they're making it really easy to transact. That's one of the reasons why you're seeing EV buyers actually a little higher rate than your typical ICE buyers. This is actually a screenshot that I took. This is actually my login to Amazon. I was curious myself what it looked like, and then Hyundai's got a relationship with Amazon, and I was starting to mess around in here, and I was like, well, I don't see where to get credit and financing here. If I wanted to buy a car on Amazon, how do I finance with my credit union? I'm a proud member of Community America Credit here in Kansas City. How do I find financing? So this is going to be interesting, and this is where I think the industry is going to have to. I mean, use this word again, hunt as a pack. I think we're going to have to, with these big national opportunities, cranes are going to have to come together, I think, to kind of consolidate and try to collectively go after this business and then participate on the back end about how to service those loans. And here's why, because they're looking for some of these opportunities like Amazon, CarMax, I think Tesla is one that we've worked with, but so we have real firsthand knowledge there. They're trying to make this transaction seamless, and they don't know how to work with credit unions and work with 1,000 credit unions that have different membership criteria, different rates and terms, different advanced structures. So they're looking for the easy button. They want something that's consistent. They want consistent. They want their workflow. The member comes through their tech stack and their process. They need it to be easy. So I think credit unions in here to compete are going to have to hunt as a pack. Our former chairman of the board, who's the CEO of Security Service Credit Union in Texas, he kind of coined that term. Credit unions going to hunt as a pack to remain relevant here. And I think we can do that if we just stick together, kind of like we did originally in the original Cuddle model, right? And we're able to get a gate market share together. I think this is the way we're going to compete, and I think we can be successful here. This one doesn't keep me up as much at night. Look at the just different ways. So you've got these online marketplaces, auto lending channels. You've probably seen some of the advertising of some of this TrueCar, Roadster, Amazon, obviously, Carvana, Car Gurus, Car Bravo. These are the online direct to consumers auto sales models, right? These are kind of more that do it all. And then you've got these straight to consumer like Tesla and Lucid and Rivian. We're working with these, helping credit unions do these loans all day. But I think we can help credit unions and each of these tranches here be competitive. But we're going to have to do it together. It's not just it can't just be one big credit union. I think even the biggest credit union out there, maybe a Navy, maybe a PenFed could do it like this. But I think even the biggest credit unions are not going to be able to compete with some of these channels. They're going to have to combine with other credit unions to actually have a unified front. It's not just the EV companies. You're starting to see even the manufacturers get into this e-commerce space. These are just a couple of examples of Hyundai, GMC, Caddy, and BMW. And again, I think just talking about, just kind of wrap this up, and credit unions in general have been really, really good about this side, this non-shaded side, this pink side, about car dealers, refis, doing RVs, boats and motorcycles, direct lending. I think really, really well. This we call embedded finance. This working with national groups, these EV companies, online shoppers, direct to consumer, even some non-auto things that's in there. I just think credit unions, again, we're going to have to kind of have a unified storefront, if you will, how to really be relevant with how this is shifting with consumer behavior, also with these manufacturers and EV companies and these national groups. So I think there's a lot of opportunity here, and I think credit unions can be successful here. EV update, just this thing. This you're starting to see a flattening. Remember, the federal incentives went away. They used to get a tax break for buying EVs. That went away back in right at the end of Q3. I think this. I'm reading some articles now that may kind of contradict this. That there's starting to still a softening on the EV appetite by the consumer. I think there's still going to be an increase here. Just there is an appetite here. I think this hockey stick is just going to shift to the right a little bit, maybe a year. But they're still expecting consumers to actually start making that conversion to EVs. Again, just Tesla does own a lot of this deal, but the crazy thing, look at a lease payment on a Tesla Model 3. I mean, that's pretty affordable for some people. They're making it pretty easy to do business with from their lease, but um, it it is going to change. Tesla had a little bit of political headwind there, and they're starting to, with Elon kind of being a little weird, but he's come back and starting to run his business again. They had a nice third quarter. Obviously, they're one of the stock market darlings. They're going to be okay, but they do own a lot of this market share when it comes to the EV deal. I think you're going to see some people go to this hybrid. There is an increase in 2024 over 25. That's probably one of the growth areas too of this segment. Probably more of a hybrid than true EV as people make that transition. But we know this when consumer buys an EV, they're typically EV buyers for life. They typically buy another EV over and over again. So as we serve members and be able to finance those, it's something we're going to have to watch and how to tailor our programs to make sure we're capturing this space. Talked about Tesla, Model Y and Model 3, obviously the big ones. Starting to look kind of like it used to be. You look at the average score of an EV buyer. Although Teslas are typically really high, but this is all EVs. They're starting to come down, looking a little more normal, like an ICE buyer. So there's not this segmentation like there was. Tesla is the exception. They have a phenomenal. They pull through a lot of high-end consumers, very wealthy, very high scores. But overall, it's starting to kind of come back to like a normal vehicle. Just a couple fun things. This is actually a true story. I think there's probably some regulation that's going to push against this, but this is kind of funny. If you looked at the EV repossession, maybe that'll change the game when it comes to the other side of auto lending, right? Is when you have to actually go get a car, but they unlock the car, they locate it through GPS, they back the car out of the parking stall, unlock the car remotely, then made it available for the repo truck. So that's kind of funny, pretty cool. I think there's obviously some collection law and some of that. We'll see how that all plays out, but that's at least the one account of that. And then Ford was doing the same thing. They were trying to actually patent their technology to, allow lenders to go get their cars, remotely, right? And actually have them self-drive back to a safe spot where your tow truck can go get them. Last but not least, we always want to take, Jeff and I always want to take a moment, just, thank you for allowing us to be part of your ecosystem as a QSO. We support CMN. I donate thousands of dollars every year to CMN through various events throughout the year. But we've given $16 million. We just in 1 million last year. We'll easily exceed that this year. Again, we're really supportive. And this is something that's near and dear to a lot of the hearts here of us that work here at Origence. And just again, we support all the same institutions that you do, and it's we're an honor to do that. We're a big supporter of the CCUA, and thanks again for having us in. But we do eat what we hunt. We believe in this industry, and that's what makes us different. And I want to just take a minute to do that. And I'm going to land the plane here with you, Dean. And I just want to say, Dean, thanks for the invitation. I hope this is a little bit informative. And thank you very much for having myself and Jeff and Origence participate today.
I did have one question that I found that I heard today on the morning news, as a matter of fact. So yesterday I read that Ford is stopping production of their all-electric Ford F-150.
All the same thing.
And then this morning there was a report that the president thought that people can make cars more affordable if they start building smaller cars. But the problem with the United States is no one wants to drive a sedan. Everyone wants an SUV. So, everyone keeps saying the trends for electronic vehicles are going to keep increasing, but do you see the production of them continuing to increase without necessarily the demand? Because I don't see the average consumer being able to afford a $50,000 electric vehicle unless they're going into the used car market.
Yeah, it's leasing obviously is one way they can keep that affordable, right? And that may be the way for these vehicles there because they're a technology platform, then probably be more than a vehicle. So, and they just want, just like I lease my phone, there's probably a little bit of truth to that. Like, hey, I want the new model every 2 to 3 years. I'll just keep leasing it. So that may be one way, Dean. But you're right. I can tell you anecdotally, just people, and I read an article as well, about a year ago that the Lightning was the Ford F-150 they're talking about, and it just, people have trucks because they want the space. They put stuff in it and they tow their boat or they tow their trailer or they run their business out of it. And it just the longevity of this the range of the battery probably was probably one of the downfall of that one. But they can get a lot of range now of these smaller vehicles. And there's you go to California near our headquarters in Irvine, California. You look out the window, you'll see a Tesla Model Y or Tesla 3 drive by on the street and outside of our window about every 90 seconds. I mean, it's their, so I think it's market driven a little bit. I don't think your rancher in Wyoming is going to probably want to do that, but I think you're in the big city. You know, I think there's going to be people are going to want those vehicles, but
So it's really going to be more geographical
it is.
that's driving the
Have,
demand.
sometimes I put a slide in this presentation where it's like a heat map of the United States of where all the EVs are. No, there is some up in like Boston and up in the New England area. There actually is a nucleus of EV buyers. California for sure, Washington, actually Texas, believe it or not, has because of the metro areas of Dallas and Houston. There's some there, but yeah, if you go more rural, you can see it kind of lighten up as far as the EV appetite.
What trends do we see on first-time auto buyers? Newer credit history, older vehicles, etc.
Jeff, maybe you want to help me out with this question. I don't have any data at my fingertips as far as newer vehicle first time buyer type of thing. I know if you talk to a dealer, they all want a first time buyer program, but that's just them wanting to push vehicles. But Jeff, I don't know if you've got a comment on this
Yeah,
one.
no, I'd say you're kind of spot on it. That is a market that really I think credit unions could exploit, right? Is that I actually have a credit union locally that just came out with a first-time buyer slash college graduate program for dealers, right? And so kind of mimicking, we've seen that with like Toyota and things like that in the past where they do special programs. I think that's an underserved market, right? I mean, it's the chicken or the egg because you got the young 20 something right out of college, first job, what have you, but they don't really have credit history, right? I just went through with my daughter, right? She just purchased her first car, and yes, she has a $500 car payment. So it's scary out there. And again, it's to get anything affordable, and I think that's where historically credit unions have been very conservative. They want a decent down payment, things like that. I think it's I see a lot of credit unions that limit, whether the dealer can sell a warranty or stuff, but those are the same ones that, first car, they don't know what the cost is to own a car, right? Those of us who have had several vehicles, we know things break down, things cost money. So I think that's really where credit unions can even get some more market share, right? Is that's the banks and the captives aren't really doing that as much, other than maybe Toyota Financial. So.
I did have another question or more of a comment, I guess. I know historically, Toyota Finance has always been right up there with positive growth. Are they stricter on their financing than they have been in the past? Are you seeing that trend, or is Wells Fargo just coming in with better, more aggressive rates?
Wells had their lending restrictions expire. They had some lending restrictions for a few years because of some of the, I don't remember the whole legal stuff, but there was some problems that limited what they could do
Okay.
a few years back. That those handcuffs kind of came off this year, and so they kind of went, jumped right back of the, 2 feet right into the deep end, right? So that's kind of why we're seeing that trend. But to Dave's point earlier, we see them continuing, right? As long as they stay out of trouble, they're
Don't
always
open
going to
it.
be pretty aggressive. That's kind of their backbone for auto
All right.
lending.
So,
Toyota Financial has done a great job over the years of it's the Toyota brand, right?
right.
They will, if you're buying a Toyota, you don't, whether you have good credit, bad credit, or whatnot, Toyota Financial will finance you because they want to keep that brand loyalty within Toyota. So they kind of use their finance department to leverage that as well.
I want to take the last minute here to thank both Dave and Jeff for hosting today's call, sharing all of this information. Thank you for everyone that joined, and I wish you all happy holidays.